Well, today we're going to look at options trading, and I'm talking about standard options as opposed to binary options. If anyone is new to trading options, the place to go is called Doe, tradedoe.com, if I'm reading that right, trade.doe.com. These guys are great, and they've got all kinds of information. This is their homepage. And what I like about these guys is that not only can you trade through this interface, and they use TD Ameritrade as the broker, they've got a thing called Doe University where they will walk you through the entire process of how to trade options. They'll show you how to use the interface, the definitions and basics, probability, volatility, some intermediate options, where do I start, basic strategies. And once you go through this, they also have a lot of videos and things, and they have a morning show called Tasty Trade, where they'll go through the markets and explain things to people. Up here is the trade interface, and you log on to your broker account, and you get that through TD Ameritrade, and then you can place trades. And right here is the interface, and right now it's set at 2 days. You can expand that. The first thing you do is pick a strategy, and there's all kinds of names. There's verticals, strangles, straddles, iron condors, butterflies, something they call jade lizard they made up, calendar spreads, and all this. And you can buy stock too, if you have the right kind of account. Let's just start something real basic. Vertical. You got calls, you got short puts, and let's just do this as an example. Let's do a short put vertical. So you just click that strategy and hit go, and then it's going to put this on this kind of chart here, and you can take that and expand it or shrink it down. Let's go the other way with it. Okay. Now this particular option is only good for 2 days till it expires. If you want to get a longer option, you can click on this, and there's 7 days or 10 days, and it'll go out, 2-3 months. But let's go back to let's just do a 7 day. This will work. Okay, so essentially what you have is you're selling a put and you're buying a put, and you're calling this vertical spread, and brokers like for you to have this because it reduces the amount of margin you have to use and your vulnerability to the market. Now what's interesting about this interface is that it's going to give you how much you receive on the trade versus the probability of the trade working out. On this type of trade, you want to be out of the money. In other words, this green area is out of the money. And on this, what that means is that you don't want the price to end up being above these strike prices at the end of 7 days. You want them to be above. Now, you don't have to leave it right there. You can move these strikes anywhere you want. And every time you move the strike price, it's going to tell you the probability of that strike price being out of the money at the end of 7 days. Which is real nice, because what you're doing now is you're trading probabilities as opposed to price action. See, everybody goes around with their little charts and indicators, and they're sitting there trying to figure out, oh gosh, which way is the market going to move, what's this going to happen. Well, with options, that doesn't matter, because what you're trading is the probability of a certain event taking place at a certain time. And at one strike price, if we'll go out to that, it's called one standard deviation. Okay. And we're going to move this out. Alright. And what it's saying here is that you have an 84% probability of this thing working out. And as a result of that, they're going to give you a 55-cent credit, which is good for 100 units. And once you set this, and you can go review it what it's going to tell you is that at the end of 7 days, if this trade is out of the money or if it's above this strike price, okay, you're going to get $55. Now initially you're credited $55 because it's a credit trade. There's credit trades and debit trades. Credit trades is what you want to do. You want to get a credit. It's like collecting a premium. It's exactly that. It's collecting a premium. Now they're going to want you to put some money aside. They're going to hold back $445 that you can't use for your account. They're going to subtract that from your account in the sense they'll put a hold on it. So if you have $1,000 in your account, they're going to hold back $445 as collateral against this trade, and then you're going to have a $3 transaction. By the way, this is being traded on the SPX, which is the S&P 500, which is an index, and that's usually a real good thing to start with, or indexes, because they're very stable, generally speaking. So what this trade means is that at the end of 7 days, should the price be above your strike, okay, you're going to get $55. Okay, if you don't like that, you can always edit the trade. I think it's a 20/20, whatever. You can say, well, I want a little more money and I'm willing to afford a little more risk, so maybe you'll put it at 80%, which means now you'll get $80 as opposed to 55. Okay, and you have to put up less money. So that's not a good thing. It's not a bad thing to do. Let me show you one more strategy that people use, and this is similar to what we were doing on Nadex, and these are called iron condors. They're very popular, especially for beginner traders, because they're easy to do, and you just set these up at a certain standard deviation, and what you have is you have one vertical spread that's a call spread, and then the other one is a put. And if you don't know what the difference are between those, you can find that out in the university. Let me increase the time to 7 days because I think it's a little better. Okay, so right here what we're saying is that we're going to trade at one standard deviation, and that means you have at least a 67-68% probability of this being between these two strikes, if I'm reading that right, 2020 and 2130, somewhere like that. And what you'll get is a 95% credit, which is $95, and you'll put up 405. Now, what's interesting about options is that the broker is not going to hold back money on both sides of the trade, because, as I said before in the other premium collection video, the market cannot end up being in two places at the same time. It's either going to go up or it's going to go down. Alright, so as long as it stays between these two strike prices, alright, it's going to be out of the money on both these trades, and you'll collect all that premium. Now if it goes above this, you're going to have to either get out of the trade or roll it out, and that's a kind of more advanced feature. But anyway, this is something that you can look into doing, and the thing that's really nice about the setup with TD Ameritrade is that you can trade 7-day options, weekly options, and that's real nice because you can go in and make some money, and you can do it in a week's time. And these are pretty good trades. If you want to go in and do a trade at 80%, put up $400 and make $100 if you want to do that. Of course, there's a lot more to learn, but this is a basic idea how this works. And if you're interested in learning more, you can go like I said, trade.do.com, and or you can go on YouTube, look up Tasty Trade. These guys are the gurus when it comes to trading options, and I have an account. I've used these guys, and they're good. They really are. I think it's something you can add to your portfolio if you want to have another way of looking at the market and trading the market. I'll guarantee you, if you learn how to trade options like this, binaries are a piece of cake, because these are the granddaddy. This is the big daddy of trading options, and it just makes a lot more sense to me to trade a probability than sit there and try to chase a rabbit around the yard, figuring out, oh, which way is the market going to go? Well, who cares? Market can go up, go back, go down, go sideways. I mean, it doesn't matter which way the market goes. As long as it stays within the boundaries that you set in terms of a probability, you're going to make money, collect premiums. Just makes sense to me. All right, that's all for now. Talk to you later.